The broadcast is now starting. All attendees are in listen-only mode.
Good morning or good afternoon, and welcome to our webinar, Basel III, the Final Countdown. My name is Jeff Rigsby, and I'm the President and CEO of CB Resource. First, I'd like to thank all of you for taking time out of your busy schedule to join us this morning or this afternoon. In our invitation, we said the session will run about an hour, and we're committed to keeping to that schedule. I'm also pleased to announce we have over 280 participants on our session this morning, representing about 45 states in the District of Columbia. So clearly, with 2015 coming upon us, there's some significant interest in Basel III implementation. Before we get started, just a quick comment on CB Resource and Finance 500, your sponsors for today's webinar. The companies joined forces under common ownership midway through 2014. And I'd just like to say we're committed to providing community bankers with the highest quality ERM solutions, planning, and fixed income products. Through our complimentary webinars, we hope to bring you useful and insightful industry information, and together we're focusing on assisting our clients to maximize earnings and bank value. Also worth noting, we will be recording this session, and we also intend to repeat the session probably in the latter part of Q1 as we get closer to reporting time. Our presenter this morning is Kent Fisher. Kent's a partner in the regional CPA firm of Bavernack, Trine & Day & Company. Kent has over 30 years of public accounting service to the community banking industry and has been a Basel III subject matter expert since it was first announced in 2012. VTD has a large community bank practice. Deny. Okay. A little interesting. VTD has a large community bank practice concentrated in California, and Ken is located in their Laguna Hills office. So without further ado, I'd like to introduce Mr. Kent Fisher.
All right, thanks, Jeff. Glad to be here, and we're going to start right out with the presentation here. I've got 63 slides in 60 minutes, so it's going to be a bit of a race here. Essentially, we're going to do a quick overview of the main provisions. We're going to do a deep dive into some of the more complex areas that have broad applicability to community banks. We're going to preview the new forms and some of the instructions, and finally we're going to preview this RCR Part 1 tool that we have made available. And we've got a couple of examples that we're going to go through at the end to help train you on the use of that tool. The availability of the tool is really the value-added aspect of this webinar. I think it's the star of the show, so to speak. I think Basel III webinars are a bit of a dime a dozen, but I think this one sets us apart a little bit.
And Kent, if I may, just an announcement on the tool itself. We did send a link out because there's macros. It was difficult to put on our website. For many, about 10 or 20 of you, you signed up late in the, let's just keep colors. So about 20 of you did sign up in the last 30 to 45 minutes. So by all means, shoot us an email if you did not receive the link to the worksheet, and we'll certainly get that to you, or we'll get that to you during the presentation itself.
Okay. And they shouldn't really need access to the tool itself during the webinar. It's just afterwards, basically. So, so that's what we're going to do. And for what we have to do on the tool is we have to thank the owner and the developer of the tool, which is not my firm, VTD. It's the firm of Whipfley, which is a firm that is headquartered in Milwaukee, Wisconsin. It's a large firm. I think it's in the top 25 in the United States. There's 1,200 employees. I think they service over 500 banks, mainly in the Midwest, but I think throughout the country. And VTD and Whipfley are both members of this second group here on this slide, which is the Community Banking Advisory Network. That's an association of firms, of 18 different firms, of which Whipfley and VTD are two of those firms that basically network and collectively serve over 2,000 banks in the United States. And so this organization has been around for over 20 years. We collaborate a lot on a lot of different things. This is the most recent collaboration, and I do up above here give thanks to Brett Schwantes, who's a senior manager at Whipfley. I know he's in on the call today. He initially sent this working draft of this template to me sort of as on a surprise basis a couple months ago, and he and I and a few others within his firm have sort of worked to get it to where it is today, and hopefully it's ready. We think it is. Yeah, but without that sort of networking that exists, this this webinar I don't think would be taking place. And so many thanks to Brett in particular, who did a great job developing the tool. He has a lot of great Excel skills that will come through, and also CBN. And finally, to CB Resource, of course, Jeff and his affiliates. Jeff and I have been working together for 4 or 5 years on several different projects, a lot of webinars and seminars and newsletter articles, things like that. And suffice to say, there's a high level of mutual respect between the two entities. We refer them in to our clients regularly, and they always do a great job for us on capital planning, ERM, things of that nature. So that kind of gives you a feel for how this webinar came into being. So let's get started into sort of a 40,000-foot start to this. We're going to get into the deep weeds by the end of the session. First up here is Basel III a big deal or isn't it? And it depends. I think the higher minimums on the effective date here coming up on January 1st, as well as the higher ratios in 2019 after the conservation buffer kicks in fully, I think are not that big of a deal. And the reason I say that is, and we can point to a CB Resource study that occurred last year as of June 30, 2013. For banks of less than $3 billion in assets, you can see here that a vast majority of the banks are well above or above the 8.5% threshold level of Tier 1 to risk-weighted assets. Only 108 banks are below that threshold. And to further make that point, this is the median amount of the capital for those banks, and you can see they're up in the 13, 14, 15, depending on the asset size of the bank. And so you can see that for those reasons, it shouldn't be that big of a deal as far as the increase in the minimum ratios. I think a bigger deal is the conservation buffer that kicks in for the first time by operation of law. If you don't meet the minimums, there are sharper teeth that have been provided for, in the sense that there are limitations on payments such as dividends, discretionary bonus payments, as well as stock repurchase payments. Those are limited under the Basel III conservation buffer rules. So that's a big deal. There was never that sort of teeth before in the previous capital frameworks. Another big deal is these higher capital levels that will ultimately result because of the conservation buffer, I think will, by mathematical certainty, reduce the amounts of ROEs for community banks. It's just it's the banking profit model, and the less that you leverage, the less ROE that you generate, and therefore perhaps the less that investors are interested in investing in a community bank. And so that's just one of many structural hurdles that the community bank industry is facing today. The complexity and related administrative burden is significant, notwithstanding our attempt here today to mitigate that. I think we will help you mitigate this, but this, again, is just one of many things that are happening on the complexity administrative burden front. And in that regard, I did want to highlight this petition that the ICBA recently filed that is, basically this is the banking industry sort of trying to push back on the mountain of red tape that is coming its way, and it's basically advocating for a streamlined short-form call report process in the first and third quarters. If the bank is highly rated and they're well capitalized, then they will hopefully be able to do the short-form report. So this is certainly proposed. It's certainly not been accepted. We'll see if it has any, if it results in any sort of relief. We can hope. All right, so let's get into the basics of Basel III, and first of all, we're going to cover a timeline and transition, and then we're going to get into the 4 main objectives of Basel III, and those 4 objectives are to enhance the quantity and quality of capital. That's basically the numerator of the calculation, and that involves introducing a new common equity Tier 1 capital, so CET1 is the common reference for that. There's increases in certain minimum ratios, and there is tougher criteria to qualify for CET1, as well as some new adjustments and deductions. And so that's sort of trying to clean up the numerator piece of the calculation. The denominator piece is to enhance the sensitivity, and that is just an increase in the risk weighting of certain assets. So we're going to be increasing the denominator, which is going to reduce the fraction ultimately. And then the 4th objective is to enhance conservation of capital in the good times, so that it's there in the bad times, essentially. So that's the conservation buffer concept. And so that is where we're going to, that's sort of the broad framework of how we're going to do the basic understanding here. First, let's get into the timeline and transition period. Note at the top here that this is the capital adequacy framework, and it's good to maybe sit back in our chairs and remind ourselves that we have two frameworks that we operate under in the banking industry. We have the capital adequacy framework, which is the main framework, and then you have the prompt corrective action framework, which came in with the S&L crisis back in the 80s and 90s and was basically layered on top of the capital adequacy framework as sort of an early tripwire. I would say most of my banks currently manage to the prompt corrective action framework because that's sort of the early tripwire. That's going to change under Basel III, and the capital adequacy framework is where the action is going to be going forward. So all of these new ratios and the conservation buffer phase-in, as well as the deductions and adjustment transition here, all pertain to the capital adequacy framework, and I think that helps to sort of establish that base before we get into the details. You can see here, I put up here the current percentages compared to what they're going to. There's a 200 basis point increase in the Tier 1 ratio, which is the most significant. The new CET1 comes in at 4.5%, and there's no phase-in there. Those just come in effective 1/1/15. Where the phase-in starts to occur is in the conservation buffer. Significantly, there is no conservation buffer in 2015, so those banks that are sort of close to the edge here on their capital ratios, they get a reprieve essentially for 2015. They don't have to worry about those limitations on payments this year, although it's not that far away. They basically kick in 2016 at 62.5 basis points, and then each year thereafter it increases to the total of 250 basis points. So essentially the new minimums would be the sum of the new totals over here plus the 250, and those add up to these numbers here. Finally, on the deductions and adjustments, certain deductions and adjustments are subject to transition so that they are essentially not as painful in the early years as they will be in 2019, for instance, when it's fully effective. And we're going to go take a look at those right now. Here are the new deductions and adjustments that are subject to transition rules. There's 4 items here, starting off with disallowed intangible assets. I have highlighted the core deposit intangible in red because that's an existing item, and so that's an anomaly in the way they wrote the rules, essentially, and the way they developed the forms. It's an existing item, and therefore it really shouldn't be subject to transition relief, but it is. So basically what's going to happen here is that the core deposit intangible is a 100% deduction in 2014. It will be a 40% deductible item in 2015, and then it'll follow on through with all the transition percentages going forward. So that's just an anomaly. I guess it's enjoy it while we can, I guess. It'll help our ratios to a certain extent. A new disallowed intangible asset is a non-mortgage servicing asset. It's just flat out disallowed. So that's something that is a significant change. That is subject to a transition period, so it'll be 40% excludable this year, then 60, 80, 100 going forward. Another new item that is a deductible item is the disallowed deferred tax assets relating to NOL carryforwards. That's a new item. I highlighted that with a red asterisk because it doesn't operate in the typical 40, 60, 80, 100 transition fashion. The transition relief on NOL carryforward DTAs is only available to the extent you have additional Tier 1 capital to offset it. And so that is another anomaly that you have to be aware of. A lot of banks do not have additional Tier 1 capital items. So essentially, most banks are not going to have any transition relief if they have DTAs relating to NOL carryforwards that pop up with the new rule. So that's something to be aware of. Non-significant investments in capital of unconsolidated financial statements. That's a bit of a mouthful. The bottom line is it's not going to apply to very many banks, and we'll get into that a little bit later. So we're not going to worry about the transition there. Finally, the threshold items deduction is subject to percentage limitations, and we have 2 items that are included here. We have mortgage servicing assets as differentiated from non-mortgage servicing assets, MSAs, as well as timing difference deferred tax assets in excess of recoverable tax history. When we get into the deferred taxes, you'll find out that there's 3 buckets. There's the NOL bucket, there's the recoverable tax history bucket, and there's the timing difference in excess of recoverable tax history bucket. And that 3rd bucket is what gets subject to these threshold item percentage limitations. And if those kick in, which in many banks they won't, but if they do kick in, there will be transition relief for those threshold item deductions. Here's a snapshot of the capital adequacy as well as the PCA well-capitalized framework. And this sort of helps us get our bearings as to where the minimums are. I'll point you over here to the far right-hand column. That's the PCA well-capitalized. You know, those are, you can see in black the new percentages, in red are the previous percentages. And you can see that some increased, some have not. At the top row is the leverage ratio calculation. So that is a non-risk-weighted ratio. That's just Tier 1 leverage. Where the action is in between the two dark lines in the center here, when those are all the risk-weighted ratios, basically. CET1, Tier 1, and total. So all three of those risk-weighted ratios are basically going to be subject to the capital conservation buffer. And I've kind of highlighted here where I expect the pressure points to be, and you can see that essentially with the conservation buffer in place for Tier 1 capital, there's a 450 basis point increase from the current minimum, and that's quite an increase, I would say. So there might be some pressure there. Also, relative to the PCA well-capitalized, that was previously 10% on total. That's going to be at 10.5% under capital adequacy. So just a little bit of a 50 basis point increase is going to make that the highest percentage out there between the two frameworks. Not to mention there's more teeth relative to the conservation buffer. It's helpful, I think, to understand this entire discussion by looking at this pyramid, essentially, because the common equity Tier 1 is the starting place for all the most purest form of capital, as well as all the adjustments and deductions. And once you get that calculated, then you add on additional items. First of all, the additional Tier 1. So additional Tier 1 plus CET1 is going to equal Tier 1 capital. And then Tier 2 items are going to add to Tier 1 capital to get to total capital. And so it's important to understand the vernacular of Basel III so that when we talk in those terms, you will be able to understand and keep up. So relative to CET1, the starting point is common stock and retained earnings. That's pretty straightforward. Limited accumulated other comprehensive items. There's not going to be any adjustments here for those banks that do the opt-out. The opt-out is, I think everybody probably knows about this, where you can sort of neutralize the available for sale unrealized gains and losses and basically keep the same treatment as what we're doing right now if you make this election. I expect that 100% of the banks that are listening to this webinar will make that election. We're going to look at that form later on, so then we'll highlight it again. But just make sure that you make that election, or you will be subject to a lot more volatility in this CET1. I also have a circle here around the FRY9C for those holding companies that are filing. I think there's an election there, so don't forget to do that one too. Once you get past the ALCI, you have deductions and adjustments, which we'll look into, and then minority interest, which is an infrequent item, and that gets you to CET1. Here's the deductions and adjustments to CET1, and as we just go down the list, you can see here that there's three categories here. There's deductions, there's adjustments, there's threshold deductions. Under deductions, goodwill is a current deduction and is going to be a future deduction, so there's no change in that item. The DTA relative to NOLs is a new item, as we'd already discussed. Other intangibles, except for MSAs, you'll have core deposit intangible, which is no change there, and the new item is the non-mortgage servicing asset, so that's the new item there. And the other two are going to be less frequent. I'm not going to talk about those. The adjustments relating to cash flow hedges, not a common community bank item, so I'm going to skip that. Threshold deductions, here's the two items that I had mentioned earlier, the MSAs and the DTAs not recoverable. There is a 10% limitation on those individually, and then that amount that gets through that 10% individual limitation is then subject to a 15% aggregate limitation. And we'll go through calculations to hopefully make that a little bit more clear. Significantly here at the bottom, anything that gets through on the threshold deduction, so basically any mortgage servicing asset that gets through or deferred tax asset not recoverable, is subject to a 250% risk weight. That starts in 2019 significantly. They threw us a bone here, and they're only going to risk rate that at 100% during the 4-year transition period. So that's significant relief, transitional relief relative to that item. Because I do expect that there's going to be some pretty good-sized numbers in the MSA and the DTA not recoverable categories. Here's sort of a, this is part of Basel III that's complex but not widely applicable. I did want to at least clue you into the fact that most banks probably have some investment in unconsolidated financial institution capital instruments, probably most likely in the form of FHLB and FRB stock. However, those items are specifically excluded from consideration here, so if you have that stock, you don't have to worry about including those in the call report here. The items that do apply and where you may have to report would be the Bankers Bank type stocks, TIB, PCBBs, there may be some others, as well as some TRUP CDOs. You're probably going to be in the non-significant category here for those, because those are relatively small holdings typically. And the only way that you have a deduction in that situation is if those investments are more than 10% of your CET1, which I really don't think that's ever going to happen, at least relative to Bankers Bank stocks. Maybe you might have a CDO out there that, that might be large enough that might trip that wire. So generally this area is not applicable, but at least you know a little bit about it after this presentation, hopefully. So we're now past CET1, and now we're into additional Tier 1 capital items. And you can see the types of items that are included here. Non-cumulative perpetual preferred stock. Sometimes we see that. More commonly, we see SBLF and TARP, which was Tier 1 capital when it was issued. Basically, that has been grandfathered in and will continue to be treated as Tier 1 capital. Not CET1, but it will come in as Tier 1 capital. And we do see some of that, although TARP is getting paid off more and more frequently. We do see some SBLF, but when I made the statement earlier that we don't have a lot of banks with additional Tier 1 capital items, this is the reason. There just isn't much of it out there. For holding companies, if you're over, if you're less than $15 billion in assets, you can continue to treat trust preferred securities as additional Tier 1 items. So that would also be a holding company consideration. So those are your additional Tier 1 items. Tier 2 items are going to be your allowance for loan loss, which there's no change in that calculation from the current rules. Then you're going to have your cumulative preferred stock, subordinated debt that's longer than 5 years. We do see some elements of Tier 2 capital, but it's not that frequent. Here are some example items sort of that we see and allocated amongst the categories. I do have this asterisk here because I've cut a couple of holding companies in this situation. Actually, one of my clients brought it to my attention. There was a change in the limitation of what is allowed for a holding company that holds TRUPs. Essentially, it's currently limited to 25% of Tier 1, including the TRUPs, and the new rule is 25% of Tier 1, excluding the TRUPs. And so it's going to haircut the amount of includable TRUPs in additional Tier 1 capital, and if you're somewhat close to the current limitation, it will, I know in the case of my one client, I think it was, it's a couple $1 million that they're going to lose in capital effective 3/31/15. So I think that one is catching some people by surprise, so be aware of that if you have TRUPs at your holding company level. I also want to highlight,
yes. And this might be a little dated, but one question was, what is the best way for the bank to track DTA relative to NOL?
That's going to come up later in the presentation, so we've got a lot of detail on how to do that. Perfect. Relative to eligibility criteria, the Basel III really expanded what is necessary for capital instruments to qualify under the 3 categories. And I've sort of created a schedule here to summarize those criteria, most of which are new. I've highlighted in yellow a couple that have basically reared their head in BTD's practice, and I've got an example here of $10 million of non-cumulative perpetual preferred stock convertible into common stock with a conversion ratio adjusted based on the performance of one particular problem loan. And it was issued with the intent of it qualifying for Tier 1 capital, but when the regulators came in, they saw the credit-sensitive feature there, and if we go back to this, you cannot have a credit-sensitive feature, and therefore it cannot qualify as either additional Tier 1 or Tier 2 capital for that matter. And so you've got a bank here who thought they had it's a troubled bank basically looking to raise capital, the investors coming in not wanting to step into any of the previous loan loss problems. And so you're basically not going to be able to issue anything but plain vanilla sort of common stock if you want some of the stuff to be included in capital going forward. And there's not a lot of regulations as to what qualifies as a credit-sensitive feature, and so it's really sort of an active area, and maybe there'll be some regulations issued in the future. But just be careful when you're issuing, when you're getting creative on the issuance of capital instruments going forward. Okay, now we're into the denominator and the risk sensitivity, and there's some changes here to some of the risk weightings on some of these items. We'll get into the more common. High volatility CRE. This is basically construction loans. We're not seeing a lot of that, but you'll get 150% risk weight if you basically meet these criteria here. And I got this note here because at the AICPA banking conference, it was sort of highlighted for us that this is not a prospective thing. This applies to the loans that you currently have. And I don't think a lot of banks have operationalized this requirement, and probably need to start thinking about this is how do we identify, if we look at our construction loan portfolio, which of our loans are going to be tripping this HBCRE wire and which are not. They did come out with some additional relief here. They've excluded 1 to 4 family projects, ag purposes, secured by ag items. Community development loans are excluded. Here's the underwriting criteria. It's relatively conservative, and this is where you would really want to get into your, get with your loan department and see, are they making loans even currently that meet the underwriting criteria? Because you don't want to step into that 150% risk weight if you can avoid it. Here's some examples of what is and what is not HBCRE. Another significant change is the past due asset risk weights. Basically moving all of these types of loans from 100% to 150%, and that's for any loan that is an non-accrual or is accruing but past due in 90 days or more. Those two items will be 150% risk weighted going forward. Does not apply to 1 to 4 family residential mortgage exposures. There's no change to the current treatment on those, and HBCRE is already 150%. And then the off-balance sheet exposures, 20% conversion factor on those. So those were previously had no impact. It was only the long-term over 1 year off-balance sheet exposures that had the risk weighting impact, and now it includes also the less than 1 year. And now finally, the conservation buffer concept, and this is a limitation that's applied to the eligible retained income, which is defined over here as the most recent 4 quarters of net income, preceding the current calendar quarter, net of any capital distributions and certain discretionary bonus payments. It's a sliding scale based on how far you are above the minimum. And the best way to illustrate that is this example here, where you've got the example bank ratios for the 3 risk-weighted ratios. You have the actual, here's the Basel III minimums here without the conservation buffer. So here is the actual difference between the bank's ratios and the minimum ratios. And to the extent that you have less than 250 basis points, you're going to be limited in your payments. And you take the lowest of these 3 differences here, which is 1, and if we go back to this scale here, between 625 and 1250 is a 20% payout ratio. And so that would be the amount of the eligible retained income that you could pay out in that at that time. And so it's going to be a difficult calculation. And I will point out, too, that these percentages here are once it's fully phased in. These percentages, as you know, the conservation buffer is being phased in, and so there are, in the law, there are specific percentages that create the same sort of sliding scale, I think, on a pro rata basis, starting in 2016. So for those banks that have really low capital ratios, you'll need to want to anticipating, where you might fit in this sliding scale based on the percentages that actually apply to, for instance, 2016. They're not going to be this high. They're going to be much smaller because they're going to be based on a pro rata of the 62.5 basis points. So something to be aware of if you've got really low capital ratios, and you might want to start planning right now for the conservation buffer and how that's going to impact your payments. There was some relief here I just want to highlight real quick. S-corps are a little bit more sensitive to limitations on payments because they got to pay the tax out to their shareholders, and so the FDIC to come out with this FIL It's not a safe harbor. It's not a guarantee. It's just that they'll basically take a they'll consider these items basically when determining whether or not they'll grant you a waiver on the limitation. So just be aware of that if you're an S corp. Okay, now we're going to get into our deeper dive on some of these items: servicing assets, deferred tax assets, and the threshold limitations. Currently, the NMSAs and MSAs, you can see the current rules here. Essentially, they're not limited unless you had really large amounts of servicing assets. Under the new rules, NMSAs are disallowed entirely, subject to transition. The MSAs are part of that threshold items sequence, but unlikely to be limited by threshold rules. But it's possible. We'll get into that. If you have a 1 to 4 family sort of origination practice, then have a lot of MSAs, you are going to get limited on this probably. We have a lot of SBA lenders out here essentially, and so I do have a section here on SBA servicing assets. Typically, there was no reason to distinguish between NMSAs and MSAs typically, and I think they were commingled by a lot of our bank clients. It didn't really matter in the calculation that much. That'll change starting with Basel III. And essentially, the way this will work is that those loans secured by real estate per the RCC will be considered MSAs, and those that are not are considered NMSAs. And that distinction just becomes more important going forward because NMSAs are out, MSAs are probably in. As far as how to determine that, I think you could do a specific ID approach. You could maybe do a pro rata allocation. Either should be acceptable, I think. On deferred tax assets, here's the current rules refresher. I think everybody pretty much knows this, that it's basically tax history plus 1 year's future tax based on a projection of income. That always seemed, rather loose to me and subjective to a certain extent, and it's no surprise that the regulators have, ditched that for a different approach. Here are the new rules, and believe me, they're not easy. They highlight the tax jurisdiction, which was never highlighted before, so now we got to break out the calculation between federal and state, which was never a requirement before. There is this option to net deferred tax liabilities against such items as goodwill, core deposit intangible, and that is something that you would want to do because that helps you get bigger bang for your buck on the DTL by reducing a otherwise deductible item from capital. So that's something that you would actually want to do. The remaining DTLs after that specific allocation are allocated pro rata against DTAs in these types of categories. Basically, you've got the NOL and you've got the timing difference. The NOL DTAs are disallowed. The remaining DTAs arising from timing differences are allowed to the extent of recoverable tax history on a jurisdictional basis, so 100% risk weight. And those in excess of recoverable tax history are subject to this threshold items deduction or calculations. So there's your basically, and this is as a practical matter, how do I apply? It's basically assign the DTLs to the disallowed intangibles, and then you segregate the gross DTAs into 3 buckets. NOLs, recoverable tax history, which is purely a function of what can you go back and recover if you filed carryback returns, and then everything else. So it's timing differences, not recoverable, is sort of how I'm rephrasing that third bucket. So understanding those 3 buckets is really critical to understanding the rest of this presentation. Where we run into some difficulty is when we have to allocate the remaining DTLs to those 3 buckets. The rules are not clear as to how to do that, and I've had back and forth correspondence with the OCC, the person who did the presentation at the ICBA banking conference. I've had several back and forth with him, and I'm looking at the email right now. He's basically just saying that the law was written imperfectly relative to how to allocate DTLs. It's actually got conflicting guidance as to which buckets you allocate to. It's unclear at this point whether the regulators will clear this up with frequently an FAQ or a technical amendment to the rule, or if they'll just handle it through supervision. But basically the advice that we've been given at this point in time is to apply an approach that makes sense and apply it consistently. And so that's what we've done within the template itself. There are 4 alternatives that have been identified, at least by one firm. I've got a I will give them some credit here. It's the Wolf & Company firm. I think they're on the East Coast. They do quite a few banks. There's a newsletter there that goes into it that you could find at this website link at the bottom of this slide. They've identified 4 potential allocation methods. What I've done here is I've sort of showed those 4 alternatives, and I've highlighted in yellow the bucket of most concern, basically, which is the NOL bucket, because that's the bucket that is out. The other 2 are in, subject to different risk weighting weights. So you can see here under alternative 1, the NOL bucket is minimized at 50, and that's going to be basically the case in pretty much every scenario. And so alternative 1 is the one that we basically have ingrained into the template because basically the regulators have told us that that they don't have a problem with it, basically, and as long as you apply consistently, then that's fine. So essentially what alternative 1 is to basically insulate the tax history from any allocation of DTLs. And so that's basically, and then basically the other 2 buckets then get the allocation. So that is how we've structured the template. And if you use the template, you actually, if you put the numbers in, it should work out, and we'll get into how to do that. Similarly, if you have a deferred tax asset allowance, and this is a situation where a bank is struggling, and under GAAP you have allowance potential, if it's more likely than not you're not going to realize your deferred tax assets. And so we have several banks that still have DTA allowances. Some have full allowances, some have partial allowances. If you have a full allowance, then it's a moot point because there's nothing that's flowing through there's no asset there, basically. If you have a partial allowance, then you've got the same problem that you've got with the DTLs. There's no rule that is clear in the law at this point as to how to allocate. What we're recommending, based on interaction with the OCC, is a tiered approach where you would specifically ID the allowance to, first of all, the NOL bucket, which makes sense because the NOL is probably the most suspect as an ultimate realization. Second, to the temporary difference, DTA is not recoverable. And then third, to DTA is recoverable, because basically that's tax history, and it wouldn't make sense necessarily to allocate an allowance to your tax history. The template that we're going to be going over eventually does default to a pro rata over the 3 buckets, but you can override that, and I'll show you how to do that in case you do have a partial allowance. Here are the transition rules on NOL carryforwards, and this again reiterates the point that the transition here is more of an illusion. It's a mirage. You have to have CET, you have to have additional Tier 1 capital in order to gain relief in the transition period, so I want to highlight that again. The transition rules relative to the threshold item deductions is not a mirage. It's real. It's the 40, 60, 80, 100 if it does apply. Here's a snapshot that hopefully helps you understand how the threshold deduction percentage limitations actually work. And this is not part of the template. This is just something that I've come up with to help me understand it. Up at the top here is all the DTA and DTL allocation stuff that goes on. And out of a total of 8,299 of net DTAs after the specific allocation, 2067 is a recoverable tax history, so that is basically going to be good capital. The rest here is allocated between the NOL carryforwards, which are disallowed, and then the balance is basically the timing differences not recoverable. That's that third bucket. And that third bucket of 4037 comes down then into the threshold items calculation. So you've got the gross amount here. You've got the 10% individual limitation, 10% of CET1, which is 4108, and you can see here that we are below the limit, so no exclusion there. I've got MSAs here of 5,000. That is limited under the 10% individual, so some does not get through. That does get through gets commingled with the DTAs here, and then that total is subject to a 15% aggregate limitation, and there's a little bit of a limit here. You can see here that we do use a 17.65% because it's a simultaneous equation type of thing. It is what they want is they want to have deductions that result in, at the end of the day, no more than 15% of capital. So it's actually not a 15% limitation. It is for the transition period, but it does go to 17.65 in 2019, and that'll ultimately be what the calculation is. So leave it for the regulators to just complicate it a little bit further for us by making a 15% limitation actually 17.65. Anyway, so that's basically an illustration of how the threshold limitations work as applied to actual numbers, and hopefully that helps you understand a little bit better how it works. Here's some practical considerations relative to deferred tax assets and liabilities. When do the three components change? The NOL and tax credit carry forward number, that only changes once a year. At 12/31, when you do your year-end calculation, you're basically identifying what that NOL carry forward DTA is. And it's not going to change until the next December 31st. So for each of the quarters in between, you just use that same one, you revert back to the 12/31 number. Similarly, on recoverable tax history, that doesn't change at 12/31, but that does change at March 31st. And so that's going to change once a year, because at 12/31 you got 2 years to look back to as your tax history. And when you accelerate to 3/31, you've got 1 year dropping off and the most recent year kicking in, and so that rolls forward essentially. So that's going to change once a year at March 31st. The timing differences that aren't related to NOLs is also going to change just at 12/31. And I do have a little bit of a subnote here in the sense that perhaps if you do charge the difference, or if you record the difference of your current year tax accruals and the estimated tax payments, that difference has to go somewhere, either to current or deferred. If you put it into your deferred, then theoretically you would have to deal with it, I guess, in the context of your Basel III quarterly calculations. I might recommend that, and I guess I will leave it to your tax preparers as to where they want you to put it. If you put it in the current accounts, then theoretically your DTAs haven't changed, and therefore you can just use the 12/31 amount. Can the Fed and the state DTAs and DTLs be combined as a practical expedient? Here we say maybe. We just haven't worked with enough examples to know when it might not be advisable to commingle those. It certainly would be an easier calculation to commingle. I'd be hesitant to do so until we get a few years under our belt to see when it makes a difference. DTAs and DTLs on unrealized AFS gains and losses, same rules as before. Basically you just elect to do it consistently. I would say that most banks elect to exclude to avoid the volatility. There is no formal election required, just need to be consistent. Relative to the deferred tax inventory, that will need to be enhanced. And what I've done here is thrown up one of my clients' deferred tax inventory as it currently looks, basically, and you've got a bunch of items here. You've got the the actual temporary difference here, the timing difference, and then you've got the tax effect, federal and state, off to the right. I've highlighted a couple items that we're going to need to basically pull out going forward. This deferred tax inventory is going to need to be enhanced by the new section here that is highlighted in red brackets. And that's basically taking, I've got the schedule on the previous slide truncated, so I have the totals at the top, and then I've got the DTLs and DTAs and recoverable tax history sort of at the bottom here, so that I can essentially take the numbers up above and organize them in such a way that I can easily input them into the template that we're going to be doing here in the next few minutes. I think every deferred tax inventory is going to need to be enhanced in this fashion. You just got to get the numbers into the three buckets. All right, so let's get into a brief overview of the RCR forms here. I've copied in here, this is basically the first 5 lines of part 1. Do want to highlight here, of course, the opt-out election. We do want to opt out, essentially, of including AOCI items in, so we're going to put a 1 in this box here, so don't forget to do that. Here we get into the, the meat and potatoes of basically the CET1 calculation. You can see here goodwill is being eliminated as per normal, intangible assets, and other than goodwill, net of associated DTLs, that's new to the instruction. You won't see that currently. The deferred tax assets here on line 8 that arise from NOL and tax credit carry forwards, net of related valuation allowances, and net of DTLs. Those boxes I think are going to be active, also subject to transition adjustments. The AOCI related items, I think if you do opt out, then you're going to have an entry here in 9A. Typically you'll have some unrealized gain or loss to neutralize here. Here's the transition rules relative to line 7. You can see here the transition. Nothing really special about this. It's pretty straightforward. And remember, line 7 includes core deposit and MSAs. Don't see a lot of purchase credit card relationships. And remember that transition anomaly on the core deposit and tangibles. Here's the transition instructions relating to the NOL carryovers. And here again, it just sort of reiterates that anomaly where you got to have additional Tier 1 capital in order to actually gain relief. Here's the threshold items, lines 14 and 15. And there's your CET1 total on line 19. And then additional Tier 1 items, line 20 is where you would put in your SBLF or your TARP that qualifies. Tier 2, you're going to have potential items there. Here's your allowance for loan loss item here on line 30A. And finally, we get down to total capital here. So it's going to look much like the form does right now, but it's just going to have additional line items essentially with a lot of input considerations prior to putting the number on the line item. And they don't really provide in the instructions with any sort of tool or template like what we're providing today with the Excel tool. On the Part 2, there's a draft form that's available now, and you can see where they've added a bunch of percentages at the top. In fact, they need 2 pages to do that. You can see here you've got all kinds of really high percentages here with a lot of grayed out areas. So probably not going to apply to a lot of entities. Mainly you're going to be in this sort of spread here between 0 and 150. And you can see the HBCRE here is going to be a 150 alternative. The past due and exposures over 90 days past due still accruing will be anywhere from 20 to 150, and that sort of gets into your 1 to 4 family. Might be less than 150, but everything else is going to be 150 on that line item. Here's your unused commitments for the less than 1 year items. That's going to be new. And we have about 10-15 minutes left to look at the tool. So
while we transition, may I just run a couple of quick questions?
Sure.
Very quickly. On page 23, it makes reference to ADC loan on shopping center with LTV above supervisory maximum. What is the supervisory maximum? Can you repeat?
I don't have that offhand, to be quite honest. So I'm sure that that can be determined based on consultation with the regulators. I don't know what that is specifically. It may depend on the type.
Fair enough.
Okay.
On the phase-in table worksheet on the RCR calculator, DTAs from carry-forwards are listed as 40% in 15, 60% in 16, 80 and 17. This sounds contradictory to the presentation where I think 100% was the immediate amount of the reduction. Please clarify.
Maybe we can go back to that, the transition slide here. And, this basically gets into percentage of adjustment applied to capital CET1 and then the percentage applied to Tier 1 capital. And so it's not like like this table here. It's just a different transition table essentially. And then all it's doing is saying that if you can get relief at CET1 if you have additional Tier 1 capital, that it pushes that 60% of the deduction out to additional Tier 1 capital. But if you don't have any Tier 1 capital, it reverts back to CET1. It's just the way that they wrote the transition rules.
Gotcha. And just a last quick one. You mentioned December 31 on page 42. I assume you mean December 31, 14. Or does it mean December 31 on any year?
42. Oh, well.
It'd be December 31.
It'd be any December 31st, going forward, yeah.
Point of clarification.
Great.
Let's
All
move on to worksheets.
Let's get into the worksheets, and I have 2 examples that I wanted to highlight for you, and these are situations that I'm just aware of, either through clients or non-clients. The first example here, what I did is I just took the 9/30/14 call report, and I have a summary here that shows the 9/30 numbers, and you can kind of see they've got some capital items. They've got a small amount of AFS. They have some CDI, core deposit and tangible. They have a small amount of NMSAs as well, which are not currently a deductible item. They have DTAs. This is a bank that actually had some acquisitions, and so they have a fair amount of NOLs related DTAs that are basically limited by Section 382. And so that's why I thought they would be a good example, is that they're going to be hit by this NOL piece. In fact, just looking at the 331 column, which is going to be the column that we're going to show up on the worksheet here, you can see that they lose about $1 million of DTA because they have a fair amount of DTAs in NOLs as compared to the current limitation calculation. They do have a small amount of MSAs, and you can kind of see the ratios here. And just to kind of look ahead, I mean, there's not much impact if you look at the 331 as well as the fully implemented 331 2019. There's not a lot of change in those numbers. So actually, Basel III, and this is kind of back to my initial point, if you've got plenty of capital, Basel III really isn't that big of a deal from a impact on capital ratios perspective. And it's more the complexity of kind of getting through the call report, I think, at this point, and the conservation buffer if you do have lower numbers. So that's just to sort of highlight what we're going to be looking at in example 1. And this is also that snapshot, so I put it in there just to help you understand. If you think you can understand it better using this approach, that's fine. Example 2 is a little bit different situation, and this is a bit of a struggling bank that only has $10 million in capital. You can see their negative retained earnings are pretty high. They've been a 1 to 4 family generator, so they've generated like almost $5 million of MSAs, and you can see right now it's like a 10% limitation of fair market value. I think they've used the fair market value option on their MSAs, and so they just have a 10% limitation. Now that's going to go up as a percentage of CET1 pretty substantially. So a lot of those MSAs are going to get limited, and we'll kind of see these numbers in the worksheet as well. So let's go ahead and move over to example 1 real quick. And so now I'm bringing up the tool, and hopefully everybody can see this, and I want to just do a quick flyover on this worksheet. Can you see it okay, Jeff, on your screen?
Mine hasn't cycled through yet.
Okay.
Just as a IT-related question, there we go.
Okay, you got it? Yeah. Does it show up okay on your screen?
Yep.
Okay.
You can make it a little bigger if you want.
All right. So again, this is a Whipley worksheet, and they've copyrighted up here on the top right. Again, thanks to Whipley for making this worksheet available at no cost to us and banks across the country. There is a sort of a obligatory disclaimer at the top in red. We've tried to stress test this template to the extent we could, but there's probably going to be still glitches in there of unusual circumstances that we didn't stress test it for. So if you see anything, certainly as you're working through it and you think is an error, certainly let me know, and I can get it over to Whipley. There's some other instructions here below the red piece that you'll want to review at your leisure. Moving on to the other tabs, you have the RCR tab, which really is the main tab, and the yellow highlighted cells are going to be the cells that you're going to be transferring over to your call report. The cells that are shaded in blue and squared are your input cells, basically. And what Whipley has done here is to basically reproduce the entire RCR Part 1, along with some additional calculations here at the bottom, so you could sort of see what the effect is on your capital ratios. Another nice feature that Brett Schwante has built into this thing is this jump to instructions. So if you have a question, for instance, on common equity tier 1 minority interest, which is not a very common item, it's kind of complicated, you can jump over here and you can immediately pull up the instructions here on the minority interest CET1. And then there's a little box here you can jump back to the form. So you can kind of jump back and forth to the instructions. So that's a nice feature. All the instructions are right there at your beck and call. So that's the RCR tab. The other input tab that we have here is the DTA worksheet tab, and there's some additional instructions here at the top. Near the top here, there's a show hide the valuation allowance. So if you have a situation where you have a partial allowance and you have to deal with that, then you would want to show that. If you don't have a valuation allowance, a partial valuation allowance, then you'd want to hide that. So you can toggle that on and off. I'm going to leave it off for now. And let me go back real quick because I did want to highlight at the top of this page here where it's important to put your name of your institution at the top as well as the call report date. A lot of the phase-in effects are going to be driven off of the date that you put in there at the top left of that page. So it's very important that you get the right date in there. Back to the DTA worksheet. We're going to be looking at that in a little more detail here shortly. There's the phase-in table, which is just a data table, and then there's the instructions. And so that is the complete workbook that Whipley has made available. So let's go back to example 1, and I've got the numbers already pre-input into here. So if hopefully, I don't know if they had the instructions of printing out the example 1 and 2 input items. Did they, Joe?
Yes.
Yes. Okay. So hopefully you at least got the ability to look at this. Look at the what is basically slide, I think 45. Not sure exactly. It's right around there where it's the deferred tax inventory enhanced slide, where there's yellow highlights there on that slide, and those are basically the numbers that have been transferred into this worksheet. So you can basically, if you've got it in front of you, which I do here at the webinar site, we've got starting off with DTAs. We've got the 3 buckets here, with the first bucket being the NOL bucket. Then you've got the loss carryback, basically the recoverable tax history bucket, and then the remainder there. So we've got the 3308, the 970, and the 1017, which come right off of that deferred tax inventory enhanced schedule. And we're just operating in the federal column right now. Then also we want to put in the DTLs as a negative, and there are a lot of instructions here over here on the left as to whether you put a number in positive or negative, and you have to be really careful there because you can screw up the calculation if you put in a wrong number in that sense. So be very careful on the negative positive aspects of this. Similarly, we put the same numbers in for the state, gross DTAs and gross DTLs, the gross DTAs broken down by the 3 buckets. And then after you do that, then you'll go down into the specific allocation of the DTLs. In this case, we know that we've got $131,000 of a DTL related to the core deposit intangible timing difference. And so we're going to basically specific ID that to that particular item. And that's basically all the input we have on that sheet. Now, if the actual allocations are occurring down here, starting with rows, say, 67, and you can see here we've got the 3 buckets, you've got no valuation allowance considerations, you have the allocation of the deferred tax liability between the NOL bucket and the not recoverable bucket. We do not hit the recoverable tax history bucket, and so that is the alternative one that we referred to early. That is what maximizes the benefit to the bank relative to the DTL allocation. Before I move on back to the RCR tab, I do want to do a quick example of a partial valuation allowance. So let's say we have, in this case, a $3,000 partial deferred tax allowance. You can see that if I don't do anything after putting in the $3,000, it'll go down here and it will allocate the valuation allowance pro rata amongst the 3 buckets. That's not really what we want, because we want to specifically ID that valuation allowance to just the NOLs. And so let me go to this. And in that case, in order to specific ID, there's a box here to put that in. I'm just putting it in now. So I put it in there, and then you also need to come down to this section here, and you need to put that same amount in there. And in that case, with those 2 entries, it's going to specifically allocate to the NOL piece, and you're going to get a much better result that way. So just wanted to walk through with you that little example of how to do a partial deferred tax asset allowance specific ID allocation. So let me zero out these numbers so that we can get back to our example 1 numbers, and then back over to RCR. And here you can see the numbers. And we're just going to go down, the list here real quick. We've only got a couple minutes left. We put in the capital. You can see here the intangible assets of 480, which is, I believe, the 364 of CDI plus 116 of NMSA. There's the associated deferred tax liability that's coming over from the preview of the next tab. And so the net of those 2 numbers times 40% is the number that gets posted to your call report at 3/31/15. All right? On the line 8, the NOL piece, the 4411 is going to be the sum of the 2 items from the federal and state totals on the previous page, or the next page, which I will go to real quick and highlight for you. That's basically going to be the 3199 plus the 1212. We've got the federal and state. So by jurisdiction, we have it broken down, but it comes over here as one total. So the 4411 is the starting point relative to what the disallowed amount is, and then it has to go through a fairly convoluted calculation here to determine if you have additional Tier 1 capital items to benefit you in the transition. In this case, there is no additional Tier 1 items, and so essentially, once you get through all of this calculation, you end up with the complete amount of the 4411 as a deduction of no transition benefit for this item, for this particular bank. Down here, you can see the 15 that's put in for the AFS securities because they're going to do the opt-out. And as we continue to page down here, there's going to be items here that are generally not applicable. You've got this non-significant investments. If you have, say, let's put in $200,000 here of PCBB stock that you might have, you can see here that the 200 is pinged off of the 10% threshold. It's not even close. We just don't expect there's going to be any impact of non-significant investments in unconsolidated financial institution stock or capital. Scrolling on down a little bit further here, we have the MSAs that are put in here, subject to a 10% limitation, no actual limitation here because it's well below the 10% threshold. The DTAs that are not recoverable, 1360, well below the 10% limitation, so no limitation there in the initial 10% cut on the threshold limitations, and then we get into the 15%. These calculations in here, you can see that we're well below there as well. So no limitations on the threshold items, which we expect to be the common and the norm for most banks. And then you get into the total CET1, and after that, then the only really entry that we make is to the allowance for loan loss, and we add that in there. That flows through. And then also we can put in our average assets total as well as risk weight, and then we have the capital ratios down here below. So I see that we're basically out of time for our 1 hour. I don't think it's necessary to go through the example 2. I'm going to stop it here, Jeff, and see if there's any more questions. I do want to get back here to the presentation and just get to the last slide and give you my contact information. Feel free, really, to contact me if you have any questions. Just send me an email. Give me a call. It helps me understand what banks are up against if I get questions of this nature, and anything that we can't answer, we can always run up the flagpole to the OCC. We've got pretty good contact there at this point, as well as Brett at Whitley, and I think that pretty much concludes my prepared remarks. So anything else, Jeff?
Well, let's see if we can just hit a couple of these quickly. We want to thank you all for taking time out of your busy schedule to join us. I do want to repeat, if you did not receive any of the materials related to the webinar, please send us an email directly, and we'll make sure that you get copies of everything. We're also recording this event as well as going to be scheduling the webinar towards the latter part of Q1. So let's see if we can pound through a couple of quick questions here for those of you who'd like to stand by. We've got, let's see, what is the best source for instructions pertaining to risk weighting changes for loans, i.e. single family, home equity, etc.?
Let's see. Are there good sources out there for changes in risk weightings? There's probably an FDIC website has a good summary. The law itself, is out there and available. I think there are links within the Whitley tool. You can get to the Basel III regulatory reporting page. There's draft instructions. So maybe those links might be helpful.
Great. Okay. Another quick one. If you opt out, do you have to worry about all of this?
If you opt out.
General open-ended question. If you opt out, do you have to worry about all of this?
The opt-out language would obviously pertain to the FAS 115, the unrealized gains and losses on AFS securities. You want to opt out of including that in the CET1 calculation. So if you opt out, then you basically, what we call it is neutralization of the effect. So if you have a $15 gain in your capital as your starting point, then you want to take that $15 gain out. And so that's what the example 1 does. So you're basically just eliminating it from consideration. And you want that to occur because if you have a large amount of unrealized losses, you can create a lot of volatility if rates go up, which they're expected to do. You're going to drop your capital substantially, and nobody wants that. So you do want to opt out of the AOCI, put a number 1 in, I think it's line item 3 in your first call report, and then you'll basically be on the current system. You know, you're
Fair
going to
enough.
keep the current rules.
Last one for you. Do the DTAs, DTLs impact the calculation on a sub-S bank?
Yeah, they would still impact a sub-S bank, but just to a lot lesser degree. I mean, they basically have their timing differences times whatever. If they have a corporate tax rate, so a lot of states have a corporate S-corp rate. It's relatively small, typically, but that would be, it'd just be smaller numbers, basically. Yeah.
Very good. Well, again, thank you on behalf of CB Resource and Finance 500. We want to thank Kent for taking time out of his busy schedule to share this very timely and insightful information. We hope you look forward to our future webinars as we go through 2015. We will continue to be committed to providing useful and topical information that can help support your bank's performance and regulatory compliance. So with that, thank you. And should you have any additional questions, contact information for everyone is on the presentation. We look forward to hearing from you soon. You all have a good holiday season.